Okay, in this video we're going to look at some strengths and weaknesses of some different types of investments, looking at savings, term deposits, shares, bonds, property, and finally superannuation. So basically you can do two things with your money. Ultimately you can spend it on a range of goods and services, or you can save that money using a range of different investments, with the simplest being a normal savings account all the way to shares and superannuation, term deposits and so on and so forth. So there are a range of different types of investments, and these are the 6 you need to be aware of: savings, term deposits, shares, bonds, property, and superannuation. In terms of any investment, there's a trade-off between the risk and the return. So when we invest money, basically the higher risk you take, generally the higher return you can make on that investment. So people are only willing to invest in risky investments because they also know that these investments offer a greater return. So you will often get more money back than you would in a less risky investment. Having said that, when you invest in shares, one way that you can reduce your risk is by what we call diversifying your portfolio, which means that you invest in a range of different companies, some low risk, some high risk, rather than putting all your money into one company, which gives you a smaller chance that you will lose all of your money. So the term diversifying your portfolio means you invest in a range of different shares, so that you don't have all your eggs in one basket. So if one company goes bankrupt, you don't lose all of your money. So just want to talk through these 6 types of investments and what are some of the strengths and weaknesses of each type of investment. So starting with savings accounts. Savings accounts are the most common form of sort of simple investment, and basically what they do is they allow you to earn interest on money, and you can withdraw your money whenever you want. So savings accounts are very highly liquid because basically you can get access to your money whenever you want it. You just need to be able to go to a bank and access an ATM. So the advantage of a savings account is that there's easy access, they're often convenient, there's almost no risk. The only risk of you investing your money in a savings account is that the bank goes bankrupt, and you can lose your money if the bank goes bankrupt. But Australia's got big 4 banks, and none of those banks have ever gone bankrupt, and therefore it's a very, very safe investment to have your money in a savings account. The only disadvantage is that the interest rate on savings accounts is often quite low. You get a fairly low return than you do in other investments. Term deposits. Term deposits are like a savings account, but they're an investment where you earn interest on, but you need to keep your money in those term deposits for a certain amount of time. So you don't get access to your money straight away. You will only get access to your money after a certain date. So if it's a 3-month term deposit, you can get access to the money after 3 months. If it's a 6-month term deposit, after 6 months, and 12 months or 3 years, and so on and so forth. The advantage is that, again, there's very little risk with a term deposit. The same with the savings account. They're fairly simple, and they offer better returns than a savings account. On the flip side, the negatives are that you can't access your money whenever you want. You can only access your money when that time of your term deposit is up, so whether that's 3 months or 6 months or a year, etc., etc. And you also don't get as good a return as you do with shares and often property and things like that. There's a better rate of return than you do on term deposits, but a lower rate of return than you would get on shares. Okay, so the 2 disadvantages: you can't get your money whenever you want, and the return is not as good as it is in shares. The third type of investment, which we talked about in the first video, is that you can become a shareholder in a company. So a shareholder entitles you to a certain percentage or ownership of a particular company. A shareholder is entitled to some of what the company earns and can make money through dividends, and can also make money if the share price increases through capital gains. So that's what a share means, and we talked about that in the last video. In terms of the advantages, if a company does well, the value of your shares can increase. So the shareholder can get a dividend, and they can also make a high capital gain. The rate of return on shares is often higher than what it is on savings, and it's also fairly easy to buy and sell shares on a regular basis within the ASX between 10 AM and 4 PM every day. There are a huge number of companies to choose from with different risks and returns, so you can choose a relatively stable investment, or you can invest in a more risky asset or risky company where you might be able to make a higher return. Understanding how companies operate can be really hard, so it can be really hard to predict what the share market is going to do. That is one negative of the share market. And another one is that although risk varies from one share to another, they're often much riskier than savings or term deposits. There's a lot more stories of people losing thousands of dollars on the share market than they would on savings or term deposits and things like that. So they are the most risky form of investment. Other forms of investment, bonds. So bonds is basically when, as an investor, you lend money to another organisation. So one investor, a company or a person, lends money to an organisation and they have to pay you back with interest. So they will pay you back a certain amount of money and they'll pay you back extra to compensate for the fact that you've lent the money. So basically bonds is lending to an organisation. Eventually the entire amount is paid back at the end of the bond, so it might be like a 2-year bond where they pay you back the entire amount after 2 years, as well as some interest throughout the life of that bond. In terms of the benefits, they're often riskier than shares, and they offer higher return than term deposits. So they're less risky than shares, and they offer a better interest rate than term deposits. They're generally a long-term investment, and they're not as high a return as many shares. So even though they're better return than savings and term deposits, you generally don't get as good a return as you would with shares. Property, buying a house is one of the most common investments. You can buy property like land, factories, warehouses, etc. Some of the advantages, you can actually use it or live in it, so you can run a business from your property. It's often less risky than shares, so property is less likely to depreciate in value than shares. You can also improve or renovate it to increase its value. So when you buy a property, you might buy it for a cheap price and then renovate it and make a lot of money on that property investment. In terms of weaknesses, you need a lot of money to buy even the most basic house. So property generally costs above $400,000. You would have seen that in your assignment. There are also various taxes associated with buying property. So you looked at capital gains tax when you bought your property in your assignment. So that's another negative. And rent is often not as high as dividends. So if you buy it as an investment property, you often don't get as much money as you would on your shares. And the last one is superannuation. So superannuation, it's basically you contribute your own money as an employee or a worker into a pension for your future retirement. So at the moment you have to put 9.5% of all of your wages into superannuation, and then you can voluntarily decide to put more in if you wish, and that money accumulates and then you get that money when you retire. So it's 9.5% of your wage that you put in yourself, and then it's there when you retire. In terms of the positives, basically what happens with that money, it gets invested in all these different things. So you might have a big portfolio of stuff that gets invested in savings and in shares and bonds and all these different things. And basically a team of experts determines what happens to your shares. So they decide where they all go and what all your money goes into. There are many superannuation funds to choose from, and there's some really good ones where you can earn a lot of money from them. The other good thing about superannuation is you only get taxed 15% of your income for anything you put into super. So unlike your normal income where you can get taxed up to 45%, again like you did in your assignment, you can only get taxed up to 15% on superannuation. So you do save a lot of money in tax. In terms of weaknesses, you can't access your savings until you retire, so you can't get any of the money of your super until you actually retire or you're over 65 years of age. As some of the money is invested in shares, there's also a chance that superannuation can go down when the share market struggles. So when we had the global financial crisis, people had lost a lot of their super because they had invested their money into shares, or these experts had invested their money into shares, and then the share prices went down, so they lost a lot of money on their super. So it is risky superannuation, particularly if they're putting your money into risky shares. Thank you.